Hello and welcome back to our trader training video series. On this video, what we're going to look at is using Bollinger Bands to determine whether we have a potential trading or investment opportunity. So, first thing, the Bollinger Bands are this upper, lower and center band that is wrapped around these rectangles. These rectangles are the bars or the candles, and that represents the price movements for every day over the past 12 months. So what this indicator does is it takes this mid band, which is a 20 period average, and all that means is it's taken the closing price over every 20 days or segments, and it's added up the closing price and then divided by 20 and then plotted the data points. So it's telling us the average of the last 20 days. So that's what this mid price is, this middle band. The average of the last 20 closing price. Now we can set this to any time period that we want. The default setting is okay for us, and that is 20. So we don't need to make any adjustments there. And this upper band and lower band is a calculation, an additional calculation that's then run. Again, it takes all the data points over the last 20 days, runs them through a mathematical calculation, and then plots the upper band and the lower band at what is called two standard deviations. So essentially this upper and lower band represents historical volatility over the last 20 days. And it shows that upper and lower volatility at two standard deviations. And what that essentially means is that the majority of the price activity is typically be contained between this upper band and the lower band. Now we'll talk about standard deviation and distribution on a separate video, but just as a quick recap, what we know about standard deviations and the bell curve is that 95% of all data points are contained within two standard deviations. Now if we're looking at a set of data that represents 20 days, and then it's plotting this upper and lower band of historical volatility, then it's giving us the kind of the expected range of movements. This is where, or between, the upper and lower band is pretty much what's considered normal, because what we know is that 95% of the time price stays within this upper and lower band. So how do we find opportunity as traders? One of the ways that we do that is we look for those 5% occasions where price is outside of the Bollinger Bands, because this allows us to find what we refer to as a price volatility extreme. And it allows us a quick way to make an assessment as to whether this is something that we want to be looking at in more detail today, or should we come back on another day and wait for a better opportunity. Looking back through history, visually we can see that there was an opportunity here where price was outside of the Bollinger Band, and that's that 5% of the time that price spends outside the Bollinger Band. So we can see another indication here, another indication here, another indication here. I'm sure you can see that out of the 3 or 4 opportunities that we've identified on the chart for the moment, what normally happens is price reverts back inside of the Bollinger Bands. That's normally what happens. It's essentially reverting back to normal activity. So hopefully that makes sense. We're going to cover this in more detail, obviously, but for now, this is the philosophy of how we find opportunities. If 95% of the time price behaves normally, 5% of the time it doesn't behave normally. If we find those times where it's behaving in this abnormal fashion, then it will revert back to being normal. And that opportunity is presented itself when price is outside of the upper or the lower Bollinger Band. And that provides this high expectation trading opportunity that we typically look for on a regular basis. So that's the philosophy. Now, as you can probably appreciate, if we've got this big list of symbols on the left-hand side here, there's a lot of stocks to potentially run through. Now, what we don't want to fall into the trap of doing is checking every chart every day to see if there's one of these opportunities. So now that we've got the philosophy of, well, we're only really interested when price is making this anomaly, this extreme movement, then we want a quick way to make that assessment so that we can bring our time looking at the charts to only be looking at those charts that are ready for us to make that assessment today, and not waste our time on the other 10, 20, 30, 40, 50 or more charts that are available to us. And ultimately, there are thousands of stocks that we could look at. We don't need to look at them all every day. So we need to bring that big list or the universe of stocks down to a small list, and that's what we will look at on the next video.